Hello and welcome to Amberger Smackdown. I'm your host J. Christoph Amberger, and I'm here to talk some sense back into the markets. There are three quintessential Paul Getty quotes that I like. One is, I can afford to say what I wish. And the second, buy when stock prices are low and hold on to your securities. People seem unable to grasp these simple principles. They do not buy when prices are low. They're fearful of bargains. Let's stick with this one for a minute. Every now and then you have a week or two when you're not quite sure if the markets are just having a fire sale or if they're actually burning. There's smoke, there's lights, there's high-pitched adenoid whining, there's people rushing around with eyes as big as saucers, and your first instinct is to drop what you have and rush for the exits before you're crushed by the stampede. That's the time when you must realize that this is not a Dixie Chicks concert, but just a market correction. No need to panic. Recently, in the space of a week, Hong Kong, Tokyo, and Frankfurt erased all the gains they had racked up in the last 3 months. The Bombay Sensitive Index is back where it was 6 months ago for a 10% decline on the year. The same goes for the Russian RTS index. In 3 days of trading, almost $100 billion of valuation was lopped off the total value of Russian stocks. Worldwide losses were estimated at $1.5 trillion. There's something that inevitably occurs when stocks correct like this after a sustained bullish run. The bubble warners start crawling out of the woodwork. Actually, this breed of financial analyst never really leaves. They were around when I started in this business back in the late 80s, warning that stocks were overvalued and about to crash and burn any minute now. Of course, then the Dow was trading at around 2,000. When stocks are hot for extended periods, bubble warners just fade into the background, not making money as markets go mad. Warning against asset bubbles is a noble thing. It allows you to look smug and rational and virtuous. And when a run on a particular asset ends, you can always say, I told you so 5 years ago. Maybe write a book about it, or 2 or 3, call it the financial reckoning day or the demise of the dollar. Former Fed Chairman Alan Greenspan set the gold standard for the modern breed of bubble Cassandras back in 1996 when he warned against irrational exuberance in the American stock exchanges. He was spot on. A mere half-decade later, the US stock exchanges began a protracted, if temporary, downturn. Backseat drivers like myself might point out that most of these indices, even at their post-crash lows, had higher valuations than when Greenspan first uttered his words of caution and wisdom. But heck, who's counting? No wonder then that the now former chairman of the Fed is being credited for having played a role in this latest dip of global markets, when he was quoted as seeing a probability of US recession this year. He later qualified the statements that there is a 1/3 probability of recession in the United States. Apparently, most financial journalists and investors appear not to be quite familiar with what a 33% probability actually signifies. But Greenspan had little to do with this latest correction. After all, it originated in Shanghai. After the big run-up in the last 6 months, Shanghai and Shenzhen lost up to 9%. That sounds dramatic until you realize that these indexes are still up about 90% for the last 6 months and over 120% for the last 4 quarters. And as China's markets are maturing, they're even grooming their own little Greenspans. A month ago, one Cheng Siwei, vice chairman of the Chinese National People's Congress, warned that only 30% of companies listed on the Shanghai Stock Exchange are good to invest in by Western standards. Investors immediately started to scurry out of stocks as speculation ran rampant that Beijing would move to pop the equities bubble. Now, I don't dispute that the Chinese markets are experiencing the beginnings of equities bubbles. But frankly, I don't mind. If you realize that stocks inevitably will start moving down again at some point, bubbles are great environments to make money. More money has been lost wagging your heads on the sidelines as stock moves up than in all bubble markets combined. If Greenspan and our National People's Congress Vice President are any indication, the China boom still has 2 or 3, maybe even 4 good years of life in it, which means there's still plenty of time for both Shanghai and Shenzhen to double from current levels and then double again. After all, the Chinese government still plans to throw more than $200 billion of state-owned equity on the markets in the coming months. using pullbacks in the global and domestic markets as buying opportunities and applying a trailing stop of 20 to 30% should be sufficient to maximize your gains and lock in profits in any bubble boom. There's no good fundamental reason for further declines in world stock markets. Sometimes you just have to accept that investors do indeed behave like that swarm of grackles or pigeons that invades your backyard in midwinter. They're easy to scare but impossible to get rid of. The markets will bounce back, and China's Black Tuesday will be a minor memory by the time the Dow hits 13,000 by May 2007. Earlier, I promised you 3 favorite Paul Getty quotes, and 3's what you're going to get. Because in the face of Alan Greenspan, the perma-bearish bubble boys, and the breathless yackers of the financial media, who could disagree with him when he said, "I'm perhaps the world's greatest Laurel and Hardy fan." And what could better sum up the markets? For TaipanFinancialNews.com, I'm J. Christoph Amberger, wishing you a profitable week.